So let's get into drawing supply and demand zones using a candlestick price chart. So on a candlestick chart, supply and demand zones are preferably drawn on the daily or weekly charts, and this is due really to the volume of trading that happens within that time frame, right? Within the higher time frame. So supply and demand is a lot more powerful on the higher time frames than it is on the lower time frame charts. So we then use the daily and the weekly supply and demand zones to enter on an intraday time frame, right? Or we would use the weekly supply and demand zones to enter on a daily time frame chart and use the daily time frame chart to enter, or we'd use the daily time frame chart and use lower time frame charts like the 4-hour or hourly to enter and enter on those lower intraday time frames. So when plotting levels of supply and demand using candlesticks, we first need to identify the trend, because higher lows and higher highs, right, are where the strongest areas of demand are located, right? And lower highs and lower lows are where the strongest areas of supply are located. So the candle sequence for identifying higher highs and higher lows is really a bullish candle, a bearish candle, and then a bullish candle, where the last candle in the sequence must make a new wick high or must close higher than the previous bearish candle. And then the downtrend, the lower high, lower low sequence we want to see is where we have a bearish candle, a bullish candle, and a bearish candle sequence, where the last candle, the last bearish candle, makes a new close low or a wick low. So let's look at the demand and bullish example of what I'm talking about when it comes to the higher high and higher low principle. So we have, you know, a trend up, and we have a candle high. We get a bearish candle, right? So we have a high, a bearish candle, and then a new candle close high, right? And when we get this kind of sequence, so a bullish, bearish, bullish candle, and the bullish candle has to make either a wick high or a close high, we draw a demand zone from the bearish candles open to the lowest candle wick low, right? And this will become our demand zone. Now, if we get a situation like this, we still draw the same thing. So we get a high, we get a low, and even if this bullish candle's wick low is lower than the bearish candle's wick low, that doesn't matter. We would draw the demand zone from whichever candlestick has the lowest wick, because really that is the swing, right? If this is the swing up here, whatever candle has the lowest wick, that's where we would draw the low of the demand zone. So any candlestick's wick low. And then as long as prices make a new close high or a wick candle wick high and it's a bullish candle, then we draw our demand zone from the bearish candle wick's open price to the wick low in the sequence. Now, if we get a situation like this, where we have bullish candle, 2 bearish candles, or 3 bearish candles in a bullish candle, the demand zone will be drawn from the last bearish candle in the sequence, right? So this is the bearish candles open and to the swing low, right? And again, as long as the bullish candle makes a new high above this candlestick here, again, it can either be a wick higher or a close higher than that swing. And this is how we would draw our demand zone. So if we get a situation where we have a new high that is made, but it's made by a bearish candle, then we still have a demand zone, because we still have a higher high and higher low sequence. So let's get my this tool, right? Because this is what you're really looking for. You're looking for a new high, a low, and then this creates a new high. The problem is that it's not a bullish type candle. So although it has made a new high, this would be still a demand zone, but it's a demand zone that is of the weakest type of demand. So even though it can be drawn, preferably I would prefer not to see a demand zone like this. This is something I will rarely mark on my charts, even though it does count towards being a demand zone. I really want to see something along the lines of something like this, or something like this, where we have a bullish candle close or a bullish candle's wick high. We also have something called hidden demand, right? And hidden demand is identified by this type of sequence, where you have a bullish sequence and then you have this type of candle here. Now this type of candle has, you know, a few names, but this is some people call this an outside candle, or a key reversal candle, or a key continuation candle. But pretty much the premise of this candle, whatever you call it, is where you have a bullish candle that actually goes below the low of the previous candle, right, in the wick, and it goes below the wick low of the previous candle, but closes above the wick high of the previous candle, right? Now, why is this hidden demand? It's because throughout the day, remember this is a daily or a weekly, but let's say this is a daily candlestick, right? Let's walk through what would have happened during the day with this candlestick, right? And really this long wick would have indicated that there was definitely a lot of supply coming in during the day, and then demand obviously came in so much that it closed prices higher than the previous day, right? So if we're breaking this candle down, and looking at the candle during its stages during the day, right, we would have, that wick, right, would have at some point looked something like this. Yeah, so maybe halfway through the day, this is what would have happened, right? And this is what the candle would have looked like, and it would have created this demand. Well, it wouldn't have created the demand yet, but it would have created some supply. But then for whatever reason, it could have been a fundamental event, etc. Prices and demand came in and pushed prices higher than the previous day, right? So you would have had something like this at some point, where prices got back to where it was at the start of the day, or the start of the candle, and then you had a close higher. So this now becomes hidden demand. This is where buyers throughout the day came in, saw this as potential, an absolute bargain, so much so that they pushed prices higher. So this type of candle, where you see this type of situation where you have bullish candles or even a bearish candle in the sequence, then this is what is known as hidden demand. So let's look at how to draw demand zones and identify higher highs and higher lows on an actual price chart. Now, let's get my tool up, and what you'll find is that we've got a high, a low, and a higher high. Now, when it comes to the high, the candle doesn't necessarily, it can either be bullish or bearish. That's not necessarily the issue. It just has to create a high, and then the sequence really has to be a bearish candle and then a bullish candle that makes a new high, either a wick high or a close higher than this previous high here, right? So regardless of the swing, whether it's a bullish or bearish candle, it's it's not that significant. The fact is that it has to just make a high, and then we need to see a bullish candle that closes above. Now, in this example, what we have is a pullback. This would be the swing low. So we have something like this, high. And then a higher high is only made when a new high is obviously made, right? So the last bearish candle in the sequence before prices make a new high is this one, right? So this is where we'll be drawing our demand zone from the last bearish candle in the sequence before prices make a new high. And that's where we draw it. So this also creates, if you know the eagle eye amongst you, also created some hidden demand as well around here, because the candle actually went below the previous candle's low and went above the previous, closed above the previous candle's high as well. So this was also some hidden demand in that area. So as we go forward, prices continue to make higher lows and higher highs. So again, if this is the absolute low, got to move up, got to move down, and again, until prices really break above that level, which it did on this candle, that becomes a higher high. And then this level here, last bearish candle in the sequence before prices make a new high, is where we're going to draw our demand zone, and that's where we would draw it. Now we get a situation where I previously spoke about when it comes to drawing demand zones, and we get a new high being made, right? But it's not a bullish candle, it's actually closed bearish. Now again, you could draw a demand zone you know, around here as well, as this would be the area where the last bearish candle before prices did make a new high. But personally, I prefer to not draw it, as it can get a bit you know, the demand zones can get a bit overwhelming on a price chart if you were drawing these types of demand zones. So I would just keep the original demand zone from here on the price chart, although again, it does count towards a higher high, and if you really wanted to, you could draw, you know, your demand zone right there as well. So continuing on, we now get a new high, marginal, but it's still a new high, right? So this is the new high, and this is the last bearish candle in the sequence before prices make a new high. So we would draw our demand zone from the candlestick open to really the swing low, because you're looking at there, there, and then, so higher lows and higher highs are being made. So this is where you would draw your demand zone, and so on and so forth. So we make a new high again, just like the previous example here, where we didn't get a, you know, a bullish candle close, and we also have, you know, this demand zone down here anyway. So we're waiting for a new bullish candle high before this now becomes a potential demand zone. But as we saw, prices actually came back down into this demand zone here, and then we got this price action around here, and then what we had was, get my tool, so prices probably came just above it, around there, probably right on the nose. So what we could do is actually draw a demand zone here if you wanted to, if you know, this hadn't happened yet, right? So to the left of that hadn't happened yet. It's very marginal, to be fair. I'd probably want a bit more conviction. It's difficult to show, but I'd want, you know, definitely an obvious wick above that. But this candle definitely, you know, it's clear that it's made a new high above even that high. So once this candle makes a new close above, this now is the last candle in the sequence, last bearish candle within the sequence. So we've got move, we get the swing down, and then we get the move up. So now what we do is we put a demand zone around here, continue higher. This now makes the new high, get a pullback during the day, and then a new high. So now this area, the last bearish candle before prices make a new bullish move higher, is where we will now put our demand zone. And then we get this situation where we have a high, we get the swing, but what we don't get is we don't get a brand new high, right? So it's not clear that this is, again, a brand new high. So we can't put a demand zone. The demand zone shouldn't be put here until we get a new high. So there, and there's no new high. There's no demand zone, right? That should be drawn using that last bearish candle. So as prices do come down, and even though it does react during the day, that's not something that I would be looking to trade. Also as well, you have to keep in mind the overall bigger picture. Remember that as we go higher, this would be considered a very cheap area. Halfway would be considered the value area or fair value area. And then if we're looking at, you know, the highs of the market after seeing, you know, this move, and remember this is the daily chart from here to here, you want to try not to buy at all-time highs unless you do believe that the market is going to go higher. But look at, you know, fair value and look to buy on pullbacks, because the market will pull back. It's just a matter of time. So always keep in mind, just as a side note, when you're trading supply and demand levels, look for prices to come back down really to, you know, somewhere around fair value before looking to buy in, right? So in the next candle sequence, what we get again is somewhere near or close to fair value, and then we get a bit of a reaction around here from this demand zone around here. So when it comes to looking at supply, it's pretty much the same thing as demand. So what we want to see is a bearish sequence, then a bullish candle, and then a bearish candle where we either see a candle close below the swing or a candle wick, because again, ultimately what we're looking at is lower highs and lower lows. If this is the new low, we need to see a bullish candle, and then we need to see a bearish candle. Now, it doesn't matter whether this bullish candle is the wick is the highest, or if this candle's wick here was higher than this candle's wick. What we're looking for is just the lower high and lower low sequence. And then we draw our supply zone from the bullish candle's open price into the swing high. Wherever candlestick wick is highest, in this case is the bullish candle, So whatever candle wick high is highest, that's where we draw the top of the supply zone. But it starts from the bullish candles open price. The same way, if I go back to the demand candle, so we've got the open price of the bearish candle. If we're looking at demand zones, we'd be looking at the bullish candles open price to start, and then the wick high, and then that's where our supply zone starts from. So again, regardless of whether we get a candle close below, bearish candle close below the swing, or just a wick, as long as it's a bearish candle in the sequence, then this counts as the supply zone. And again, if we look at hidden supply within this sequence, again, it works the same way as it did with demand. At some point, this would have looked extremely bullish. This candle would have looked very, very bullish to the upside, and then it actually closed below this candlestick's wick low. So this is what we would call hidden supply. If you get a candlestick that does, you know, something like this, where the wick goes higher than the previous day's wick high and closes below the previous day's wick low. Now, again, if we get a scenario where we have a bullish candle that makes a new low, or lower than the previous low right here, this does count as supply, but it's not a supply zone. It's not the strongest, in my opinion, the strongest area of supply, and not a supply zone that I'm particularly fond of. I prefer if we have a bearish candle that makes a new low or a new wick low. So let's look at supply on a candlestick chart, on a daily chart, using the New Zealand dollar US dollar. Now, what we have here is, if I get my pencil, we have a high, and then we have pullback, and then we have a sequence. So this is our lower high, lower low sequence, and as well it's broken below that candlestick there. So as we see this lower high, lower low, this area is where we're going to be drawing our demand zone. All right, so we get our demand zone right there, and then as we make new lows, what we have is this. So this would be probably the low here, and then we made a new low. It's closed below that. So then what we would have is the supply zone start from the bullish candle's open price to whatever is the highest swing. So it's going to be there, and that's where we will draw our supply zone. And as prices again make a new lower high and lower low in the sequence, so as you can see, what we're doing is we're doing something like this. We're coming down, putting in swing, coming down, putting in swing. And again, just to remind you that until prices make a new low, we don't know whether this is a lower high, right? Prices have to put in a new low for this to now be valid as a potential supply zone, or as a supply zone. So once it makes a new low, it keeps going down, then we now put in our supply zone. Prices come back into these supply zones, we get a reaction, get another reaction, and then we make a new low. And again, we see something like this, where we have a high, prices have made a new low, prices come back and then make the new low there. So now this is our supply zone, because we made a bearish low after this bullish candle. Prices come back to this area here. So let's focus on this area now, right? So we've got a bullish candle, right? And until prices make a bearish candle low or a bearish candle close, this now is not going to be a lower low, right? So again, we come back up into this zone here where we have a reaction. And again, just always keep an eye on and be reminded of this. This is going to be your high. This is going to be your low. Try not to buy at the absolute lows unless you believe that obviously prices are going higher, but lower. But what you want to do is look again towards pullbacks into clear levels of supply, not necessarily chop either, right? So as we get some supply, we get a reaction of that zone. Now we get a new low, right? So we got a new low, which is here, and then this candle here, this bullish candle close, would be your next area once we've made a new low that closed, or the candle wick is below that low. That now becomes an area where we want to see, and we want to draw our supply zone, and then prices do come back up into that area, and then we react.